saw that fixed money back is a non-par guaranteed savings plan. Some of the key highlights of this product is the guaranteed income for the regular liquidity needs with which you can plan for your child's future expenses. It has convenient premium payment period, offers you tax benefit under both Section 80C as well as 1010D, and offers you a lump sum at maturity to fulfill your major goals. Now let's look at the first pitch, which is called as the liquidity pitch. Many of our customers would love to maintain their current lifestyle, for which they would require a plan that gives them a regular money back. Our customer has the option to pay for 10 years and then start receiving a regular money back from the 11th year onwards. We have taken an example of Ajay, who's a life assured who purchases an RNL fixed money back with the following parameters. He opts for the plan option A. He's 35 years old. He pays a premium of 1 lakh rupees for a premium payment term of 10 years and a policy term of 15 years. He gets a base sum assured of 9,14,284. He pays a premium of 1 lakh for a period of 10 years, and from the 11th year onwards, he receives 15% of the base sum assured as a regular money back for 4 years. With this money, he can pay any of his outstanding debts. He can also use it to refurbish his home. In the 15th year, he gets the last money payout, which is 40% of the sum assured and works out to 3,65,713. He also receives a fixed loyalty addition of 45% of the sum assured, which is 4,11,428. With this lump sum that he receives, he can save for his children, he can plan for a vacation, or have a down payment for his dream car. Also, in the event of the death of Ajay, the death benefit would be paid as a lump sum and the policy would terminate. So Ajay pays a total premium of 10 lakh and receives a benefit of 13,25,711. Now, let's look at the guaranteed child education pitch. In this case, Rahul, the life assured, purchases an RNL fixed money back with the following parameters. We are now opting for plan option B. His age is 35 years and he pays a premium of 1 lakh for a 10-year term and a policy term of 15 years. His base sum assured is calculated at 8,80,262. Now let's see if he survives till maturity. He will start receiving a money back of 15% of the base sum assured as a regular money back from the 11th year to the 14th year. He can use this money to pay tuitions or school fees for his child. On the 15th year, he receives the last money back, which is 40% of the sum assured, which is 3,52,105. Also, he receives 45% of the base sum assured as a fixed loyalty addition, which works out to 3,96,118. This, together with the last money back, can be used by him to plan for higher education with the lump sum benefit that he receives at maturity. So Rahul pays a premium of 10 lakh and receives a total benefit of 12,76,380. Now let's look at a scenario where the life assured meets with an unfortunate accident and dies in the 4th policy year. The benefit of this policy is that the entire death benefit, which is 11 times of the premium paid, is paid out as a lump sum, and the future premiums are waived. So the policy continues and the money back benefits become payable as and when due. These money backs, which will start from the 11th year onwards, which is 15% of the base sum assured, can be used to pay the tuition or the school fees for the child. And the lump sum, which is received at maturity, which consists of the last money back payout and the fixed loyalty addition, can be used to plan for the higher education of the child. So you see, even in the absence of the life assured, the benefits remain intact for the child's future. So the total premium that was paid was 4 lakh rupees and the total benefits that was received was rupees 23,76,380. Friends, the cost of higher education has increased several-fold and one needs an additional support for a long term to fund their child's education. we have the 10 Saal Baro or 10 Saal Pao pitch. In this pitch, the customer pays for 10 years and gets a guaranteed payout for the next 10 years. He can use the 8 regular payouts for school and college expenses, and the 2 lump sum payouts can be used for college admissions or as a start of life benefit. In this example, the customer purchases 2 RNL fixed money back policies with a premium payment term of 10 and a policy term of 15 and 20 years as given below. He uses the plan option B. He's 35 years old and he pays a premium of 50,000 for plan 1 and 50,000 for plan 2. In plan 1, he gets a base sum assured of 4,35,730 and in plan 2, he gets a base sum assured of 5,08,611. So the customer pays a premium of 1 lakh for a period of 10 years and he starts receiving a payout from the 11th year onwards of 65,630. These payouts can be utilized to pay for expenses in school. He receives a payout of a lump sum in the 15th year of 3,70,371, which can be utilized for a college admission. Post that, from the 16th year onwards, he receives a payout of 76,292, which can be used to pay for expenses in college. And at the end of the 20th year, he receives a payment of 5,08,611, which can be gifted to the child as a start of life benefit. So the customer pays a total premium of 10 lakh and receives 14,45,587 over a period of 10 years. Now let's look at a scenario where the life assured dies in the 4th policy years. In this case, the death benefit is paid out as a lump sum. The death benefit is 11 times of the premium paid. The benefit of this policy is that the future premiums are waived, the policy continues, and the money back benefits become payable as and when due. So like in the previous examples, the payouts can be used to pay for the child's school expenses as well as the college expenses. And the benefit remains intact for the child's future even in the absence of the life assured. So the customer ends up paying a total premium of 4 lakh rupees and the total benefits received would be 25,45,587. Friends, a businessman requires regular payouts to pay off his debts and other expenses that he may incur. We have the business insurance pitch to help our customers. In this scenario, he pays for 7 years and gets a guaranteed payout for the next 10 years. In this scenario, he purchases 2 RNL fixed money back policies with a premium payment term of 7 years and a policy term of 15 and 20 years. And he receives 8 regular payouts that can be used for his regular expenses and 2 lump sum payouts that can be used to pay off his debts or expand his business. Let's look at the example below. He opts for the plan option A, his age is 35 and he pays a premium of 1 lakh for plan 1 and 1 lakh for plan 2. He takes a premium payment term of 7 years for both the plans but policy term of 15 years for plan 1 and 20 years for plan 2. He gets a base sum assured of 6,59,249 for plan 1 and a base sum assured of rupees 7,76,583 for plan 2. Now let's look at the working out of this plan. The customer pays a premium of rupees 2 lakh for a period of 7 years. From the 11th year onwards, he starts receiving a regular payout of 98,887 rupees, which he uses for his regular expenses. In the 15th year, he receives a payout of 5,60,362, which he can use to pay off his loans. From the 16th year onwards, he starts again receiving a regular payout of 1,16,488, again which he uses for his regular expenses. And in the 20th year, he receives a lump sum payout of 7,76,583, which he can use to expand his business. So the customer pays a total premium of 14 lakh and receives a benefit of 21 lakh 88,444. The life assured also has a life cover of rupees 22 lakhs throughout the term of the policy. Now let's look at the benefit illustration of fixed money back in detail. The first page mentions the client's details. Details like age, name, the premium payment frequency, the name of the product, and the applicable GST rates are mentioned. Also, the premium payment and the policy term details are mentioned along with the details of any riders. The next page explains the detailed payment of premium age-wise and the benefits that the customer will receive. Being a non-par policy, FMB has guaranteed benefits that are payable. So, we have a column mentioning the regular money backs that the customer will receive and the final maturity benefit that the customer will receive, which will consist of 40% of the money back and the fixed loyalty addition that is paid at maturity. The death benefit, which is 11 times the premium, is also mentioned in the death benefit column. Finally, the applicable terms and conditions are mentioned, along with a place for the agent and the client's signature. Friends, happy selling and thank you for your time.
Hope you were able to learn some new pitches and better understand the benefit illustration.